Hey everyone! So you're thinking of starting a business in India, right? But you're probably staring at your screen, totally confused between a proprietorship, an LLP, and a private limited company. Well, you are in the right place. Today, we're diving into a complete explainer on LLP registration in India. We'll cover the pros, the cons, the features, the whole shebang. Let's get right into it.
Seriously, proprietorship, LLP, or private limited? If your head is spinning a bit right now, let me just validate that for you. It is completely normal. Literally every founder hits this exact crossroads. Consider this explainer your ultimate stress-free guide to finally untangling this decision. We're going to shine a massive spotlight on the LLP today to see exactly where it fits in your game plan. Okay, let's dive into this. Here is our roadmap for today. First, what actually is an LLP? Then we'll weigh the pros and cons, dig into compliance and taxes, have a little showdown between the different structures, and finally, figure out if it's the right fit for you. All right, part one, what is an LLP? Let's understand the structure. So, LLP stands for Limited Liability Partnership. It's a formal business structure introduced way back in the Limited Liability Partnership Act of 2008, and it's governed directly by the Ministry of Corporate Affairs in India. But here is the absolute most important part for you. It protects your personal assets. How? Well, let's look at the mechanics. Think of an LLP as a perfect hybrid, like getting the best of both worlds. On one hand, you get the awesome flexibility of a traditional partnership. You and your co-founders can manage the business directly, set your own rules, whatever works for you. But on the other hand, it wraps you in a company like Limited Liability Shield. It's basically a protective bubble around you. Let me paint a picture for you. Imagine you start an LLP and, things just don't pan out. It happens. Your business ends up with a massive debt of 10 lakh rupees. Obviously, the creditors want their money back. But, and this is a huge but, because of that LLP corporate shield we just talked about, those creditors generally cannot come knocking on your door to take your personal house or your car or drain your private savings to recover that 10 lakh. Your personal risk is strictly capped at what you actually invested in the business. Pretty amazing, right? Moving right along to section 2, the pros and cons. Let's weigh the features. All right, let's rapid fire some of the core features here. First off, an LLP is a separate legal entity. It can own assets, sign contracts, and even sue or be sued entirely in its own name. It also has this thing called perpetual succession. That basically means that even if a partner leaves or, heaven forbid, passes away, the business itself survives. The show goes on. Plus, there's absolutely no minimum capital required. You could literally start an LLP with just 1,000 rupees. And because of that flexible management we mentioned, you're running things based on an internal agreement, not some crazy strict corporate rulebook. And this brilliantly illustrates one of my absolute favorite advantages, the ridiculously low setup cost. Look, setting up a private limited company can seriously dent your wallet, but an LLP? You're usually looking at somewhere between 8,000 to 20,000 rupees total, depending on your state and the professionals you hire. It's such a budget-friendly gateway to getting real corporate protection. And the perks don't stop after you set it up. Ownership distribution is a breeze. You just set profit ratios in your agreement. No complicated shareholding math. Plus, no mandatory board meetings. Because you're skipping all that heavy secretarial burden, the LLP is practically tailor-made for service-oriented businesses. We're talking HR firms, IT services, law practices, accounting agencies, or even a squad of freelancers teaming up. It is just a perfect fit. But hey, let's be real for a second. It's not all sunshine and rainbows. There are some definite drawbacks. Number one, you need at least 2 partners. So if you're a solo founder, an LLP is a no-go. You'd have to look at a proprietorship. Second, venture capitalists? Yeah, they generally hate LLPs. They want private limited companies. Also, if you ever want to transfer your ownership, it is way more complex than just handing over some shares. Closing down an LLP is also surprisingly complicated compared to a proprietorship. Oh, and your financial filings become public record on the government portal, so say goodbye to total financial privacy. All right, section 3, compliance and taxes. Let's look at the rules of the game. There's this idea floating around. Many people think LLP has no compliance. That is wrong. And honestly, they hit the nail on the head. It's a huge misconception. Yes, it's less paperwork than a private limited, but you are absolutely not off the hook when it comes to red tape. You still have to play by the rules on the MCA portal. every year, you have to file an annual return and a statement of accounts. You absolutely have to file your income tax return. And depending on how much money you're making, you might also be on the hook for GST and TDS returns. And listen, please don't take this lightly. The government will hit you with strict financial penalties for late filings. It can get messy quickly. Now let's talk taxes, because there's actually some really good news here. The tax rate for an LLP is a flat 30%, plus your standard cess and surcharges. But here is the absolute game changer. There is no dividend distribution tax. None. That means once the business pays that flat tax, you and your partners can just withdraw your share of the profits without getting taxed a second time on dividends. For a highly profitable service business, that is incredibly tax efficient.
Okay, Section 4, the showdown. It's LLP versus the others.
Let's put them head to head. Imagine a spectrum. On the far left, you've got the proprietorship. Super easy to start, very cheap, but you carry massive personal financial risk. On the far right, you have the private limited company. This is your startup India darling. It's the absolute best for raising VC funds, but man, the compliance and costs are high. And sitting right there in the sweet spot, right in the middle, is the LLP. You get way better protection and client trust than a proprietorship, but you skip the heavy costs of a private limited. It's literally the perfect middle ground.
Which brings us to our final section, number 5. Is it right for you? Let's make the final decision.
To make this super actionable, here is a quick rule of thumb checklist. An LLP is probably your best bet if you have 2 or more founders, you definitely want that limited liability protection for your personal assets, you are running a service-based business like a digital marketing agency or an accounting firm, and, crucially, you do not need to raise investor capital anytime soon. If you're nodding along to those points, the LLP is a phenomenal choice for you. So as we wrap up this explainer, I want to leave you with this one final provocative question to think about. Are you building for immediate scale, or are you building for steady service? Because if your dream is to raise millions from VCs and go global overnight, you got to go private limited for sure. But if you're building a solid, profitable service business and you just want to sleep well at night knowing your personal assets are safe without drowning in corporate paperwork, the LLP is an absolute structural powerhouse. Choose based on your actual reality, not just the startup hype. Thanks for joining me today, and as always, keep learning.